Okay, so options trading. It's everywhere, right? Everyone seems to be
Yeah.
jumping in, making money. And you're like, wait, what am I missing here? It's that whole fear of missing out thing, right?
Yeah, totally.
But options trading, it can feel intimidating. Like, where do you even start?
Right?
And that's exactly why we're doing this deep dive. We've got a stack of resources on options trading, and we're breaking it all down. No jargon, just the good stuff. So think of this as your crash course in, well, options trading.
Yeah, it's true. And like anything in finance, it can seem really complicated. But honestly, once you understand the basics, it's not as intimidating as it seems.
Exactly. So let's start with like the super basic question. What even are e-options?
Okay, so I really liked how one of the sources described it. Imagine options like VIP tickets, but for buying or selling stock.
Okay, I like that. I can already tell this is going to be a good one.
Yeah, so it's like you're not just buying the stock, you're buying the right to buy or sell it at a specific price by a certain date.
So it's like I'm not obligated to buy if I don't want to.
Exactly. It's like you have the option to buy it at this price, but you don't have to.
That's actually a really good point. Okay, so let's say I think a stock is going to go way up. What do I do?
So that's where we get into calls and puts.
Okay.
A call option, that's your bet that the stock's going up. Like, think of it like making a reservation at a super popular restaurant.
Okay, I can see that.
You're paying to lock in a table, even if the price goes up later, because everyone and their mother wants to eat there.
That's a great analogy. I'm already getting hungry.
Right.
So what about when people think a stock's going to go down? What then?
Put options. It's like insurance for your stock. So let's say you own some stock and you're worried it might go down in price. You can buy a put option, which gives you the right to sell that stock at a certain price,
Oh,
even
yeah.
if the market price tanks.
So it's like a safety net.
Exactly, exactly.
Okay, I'm starting to get it. So let's say, just for example, I buy a call option for, let's say, stock XYZ.
Okay.
And stock XYZ is currently trading at $50 per share.
All right.
And I buy a call option with a strike price. We'll get into what all that means later, but
Yeah.
a strike price of, let's say, $55.
Yeah.
Now, let's say the price of stock XYZ goes up to, let's say, $60 per share. What happens then?
So if the price goes up to $60, you're in the money. You can exercise your option and buy it at that $55 strike price you locked in, even though it's now worth $60.
So I could buy it for $55, sell it immediately for $60, and make a nice profit.
Exactly. You got it.
Okay, I'm seeing the appeal here. So the higher the stock price goes, the more money I make, right?
Exactly. Your profit potential is theoretically unlimited.
Unlimited. Okay, now I'm really interested.
But on the flip side, if the stock price goes down, let's say to $40, you wouldn't exercise your option.
Right, because I'd be losing money.
Exactly.
So I'd just be out the money I spent on the option in the first place.
Yeah, you'd only lose the premium you paid for that option.
Okay, so it's limited risk, but potentially unlimited profit. This is starting to sound kind of amazing,
Right.
but, and this is probably a dumb question, but how do they even determine the price of an option in the first place?
It's a great question. And
All right.
honestly, there's a lot that goes into it.
Yeah, I bet.
There are a bunch of different factors, and it can be a little complex, but that's where the Greeks come in.
The Greeks. Okay, now you're just messing with me.
I know, it sounds intimidating, but they're just these key factors that affect option pricing. And trust me, they're not as complicated as they sound.
All right, I'll trust you for now. So tell me more about these Greeks. Which one should I know about first?
One of the most important ones to get your head around is delta. Think of delta like a speedometer for your option. It measures how much your options price will change for every dollar the underlying stock moves.
So if the delta is high, my option price is going to react really quickly to changes in the stock price.
Exactly. It's like slamming on the gas pedal, if you will. Understanding delta can help you figure out how sensitive your option is to the stock's movement.
Okay, that makes sense. Now, I've also heard of this thing called the Black-Scholes model. What even is that?
You know, people hear Black-Scholes model and they freak out. But honestly, it's really not that scary.
It does sound kind of scary.
Yeah, but it's actually just a tool that helps determine the fair price of an option.
So like a secret formula that simplifies things.
Pretty much. You don't need to be a math whiz to trade options, but it's good to know this model exists.
Okay, that makes me feel better. So now that we've got a grip on the basics of options pricing, are we ready to move on to actual trading strategies? Because I'm ready to make some money here.
Yeah, let's do it. All right. So trading strategies. Remember we were talking about calls and puts?
Yeah, like the restaurant reservation and the insurance policy.
Yeah, exactly. So a long call, That's like buying a ticket for a roller coaster ride because
Yeah.
you think the market's about to shoot straight up.
Okay, I'm strapping in.
Mhm.
But seriously, walk me through it. Like, how would this actually work with a real stock?
Okay, so let's say you've got your eye on stock XYZ again. It's currently trading at, we'll say, $50 a share.
All right.
And you're feeling bullish, you think it's going up. So you buy a long call with a strike price of $55.
Okay, and that option is going to cost me.
Let's say it's $2 per share for this example.
Got it.
Now, if that stock price climbs to, say, $60, like you're hoping,
I'm making money, right?
you're in a fantastic position. You can buy those shares at $55, even though they're worth $60 on the market.
And then I sell them immediately for that sweet, sweet profit. Okay, I like where this is going.
But let's flip the script. Let's say you're a little more cautious. You like the stock, but you're not sure about the market overall. You're worried about a downturn.
Okay, so I'm feeling a little less roller coaster, a little more Ferris wheel.
Exactly. That's where long put comes into play. It's your safety net.
So if the market takes a dive, I'm protected.
That's the idea. Going back to our stock XYZ example, let's say you buy a long put with a strike price of, we'll say, $45.
Okay.
And that costs you, let's say, $1 per share for the option.
All right.
Now, if things go south and the stock drops down to, say, $40, you're not panicking.
Because I can still sell my shares at that $45 strike price, even though the market's tanked.
You got it. You're protected from those bigger losses.
Okay, that makes a lot of sense. But those seem like, I don't know, kind of basic strategies. What about like the more advanced stuff?
Oh, there's a whole world of option strategies out there. We've got covered calls, protective puts. These are getting a little more into like income generation, hedging your bets, that kind of thing.
Okay, now you're talking my language. Tell me more about these covered calls.
So imagine you've got some shares of, say, stock XYZ. You're not sure which way it's going to go in the short term, but you wouldn't mind making a little extra cash on the side.
Who wouldn't?
Right. So with a covered call, you sell call options against the shares you already own.
So it's like I'm renting out a room in my house.
That's a great way to think about it. You're generating some income, but you're also limiting your potential profit if that stock suddenly takes off.
Ah, okay. So it's more about steady income than hitting the jackpot.
Exactly. Now, protective puts, those are more on the cautious side. Think of it like an insurance policy for your stock portfolio.
Okay, I like the sound of that.
If you're worried about the market taking a tumble, buying protective puts against your shares can help limit your losses. Like you're buying an umbrella just in case it rains.
I live in Seattle. I always have my umbrella.
There you go. You're already one step ahead.
So we've covered a lot of ground here, but there's one big thing we haven't really talked about yet, and I think it's probably the part that people want to skip over, but it's so important.
Risk management.
Exactly. We can get caught up in all the exciting stuff, the potential profits, but we got to be smart about this.
Absolutely. I always tell people, options trading, it's like riding a roller coaster.
Oh, here we go again with the roller coasters.
You want to make sure that things been inspected, it's safe, before you climb on board, right?
Very true. I don't want to be on a financial roller coaster that goes off the rails. So, what do we need to know about managing risk in options trading? Give me the essentials.
It all starts with a solid trading plan. Think of it like your roadmap for navigating the markets. It outlines your financial goals, how much risk you're comfortable with, and this is key, and your exit strategy.
So knowing when to walk away from the table, whether I'm winning or losing.
Exactly. It's all about making informed decisions, not letting your emotions drive the bus.
Emotions in investing, never.
Easier said than done sometimes, which is why having a plan is so crucial.
I can see that. So, trading plan, check. What else do we need to know about actually getting started with this whole options trading thing?
Yeah, it's like we can learn all the technical terms and strategies, but if we don't have the right mindset, it's not going to matter much, is it?
It's so true. I mean, understanding your own risk tolerance, setting realistic goals, that's huge. That's like step one.
Definitely. Well, we've covered a ton of ground in this deep dive. We went from what is an option all the way to different trading strategies, even touched on the mental game of it all.
We really did. And, we hit those practical first steps too, like picking the right brokerage account, understanding those account types, all that good stuff. It's been a wild ride, but before we wrap things up, I want to circle back to something you mentioned earlier, that whole trading plan thing. If someone listening is like, okay, I'm ready to take the leap, where do they even begin with that?
Honestly, it starts with looking inward a little bit.
Mm-hmm.
Before you even think about making a trade, you got to ask yourself, what's my risk tolerance, really?
Yeah.
Like, am I okay with maybe losing a big chunk of my investment for the chance to make a big gain? Or do I need to sleep at night knowing that my losses are probably going to be smaller, but so are my
So it's
wins?
not even about being right or wrong. It's more about like knowing yourself as an investor.
Exactly. It's
Mm.
about finding those strategies that match up with how much risk you're genuinely comfortable with. And then, of course, once you've got a handle on that, you can start figuring out your entry and exit points so you're not making emotional decisions when the pressure's on.
It's like having a game plan before you step onto the field, right?
Yeah,
You don't just run out there and hope for the best.
100%. It's all about calculated decisions. Do your research, analyze the situation, and know yourself.
Couldn't have said it better myself. Options trading, it's not some get-rich-quick scheme. It takes work, strategy, and a clear head.
Absolutely.
Well, on that note, I think it's time to wind down our deep dive into the world of options trading.
It's been awesome sharing all this with you and the listeners.
I really hope everyone listening got a lot out of this deep dive. Remember, knowledge is power, especially in the world of investing. So keep learning, keep asking questions, and most importantly, never stop exploring.
Here's to making smart decisions and reaching those financial goals.
Until